In this video, I will giving you the summary of corporate financial class by Professor Sembel. On the first day of our class, we talk about principal agent problem. It happens between investor and management, where the investor want to get max benefit and the management want to work lightly, relax, but plenty of bonus and high salary. Those are conflict of interest. Conflict of interest have to diversified. First is asymmetrical information and second is moral hazard. Asymmetrical information is information that not quite balanced. Therefore, the management knows more about the company because they run day to day. Shareholder knows less or no limited information about the company. Second is moral hazard. Moral hazard is tend to get the benefit for themselves. So the consequences of asymmetric information and moral hazard are tends to report only good things, so the shareholder think the management does a good job. What kind of solution for this conflict of interest? I think we have to do a comprehensive solution, not only one. So, good corporate governance consists of 5 things, which is tariff. So, the solution for conflict of interest are tariff. Tariff are called transparency, accountability, responsibility, independency, and fairness. According to Professor Ramcharan, there are 5 business essentials. First is cash, second, profit margin, third is velocity, growth, and customer focus. In this week, we also learn about McKinsey, 4 cornerstones of corporate finance, where a business values depends on who owns or manage or it might own it. For example, like golf stick is just a steel stick in the hand of an amateur, but in the hand of Tiger Woods is valuable. Capital budgeting. Decision-making criteria in capital budgeting are accept or reject a long-term investment proposal. Capital budgeting concept are estimate expected future, evaluate the project based on capital budgeting evaluation criteria, and last, decide whether or which project is good or bad. Rule of 72 are calculate time needed to double a certain amount by dividing 72 with the interest. We also learn about investment fraud. What is investment fraud? Investment fraud happens when people try to trick you into investing money. They might want you to invest money in stocks, bonds, notes, commodities, currency, or even real estate. A scammer may lie to you or give you fake information about a real investment. 3 things you have to do to avoid investment fraud. First, company. You have to know the company. Is that listed, trustworthy, unclear, and everything, especially in legal. Second is owner. By knowing the owner, you know the capability and the credibility of the company they lead. And last is product. You have to know what kind of product they sell to you, so you won't trap on fraud investment. Ratio analysis. Our financial ratio represent an attempt to standardize financial information in order to facilitate meaningful comparison over time and between firms. There are so many ratios, but in here I will explain the meaning of 4 kind of ratio. First is liquidity ratio. It measures the ability of the firm to meet its short-term financial obligations. Second, efficiency ratio. It provides basis for assessing how effectively the firm is using its resources to generate sales. Third, leverage ratio, used to measure the extent to which non-owner supplied funds have been used to finance the firm's asset. And last, profitability ratio measures the overall effectiveness of the firm's management. DuPont analysis summarizes key relationships which determine the overall performance of the firm. Fundamental analysis. First is intrinsic value versus market price. Second is Warren Buffett tenets. Third is financial statement analysis. Intrinsic value are calculated based on our knowledge of the company from the macroeconomic perspective, from the industry, from the company performance and the projection, and use discounted cash flow. This method is applied by Warren Buffett, the greatest famous global investor. He used fundamental analysis. The Warren Buffett tenets are including business tenets, management tenets, financial tenets, and market tenets. Business tenets are the business inside out in order to understand the source of value creation, the cash flow, and the management. In management tenets, you check the good corporate governance of the management if the managers already try to overcome the principal agent problem. Financial tenets, you analyze the financial reports over several periods. And last is market tenets, and then after that you calculate the intrinsic value and compare with the market price. How to know is the company healthy or not healthy? It is in financial statement analysis. First, you calculate the ratio that basically measuring risk and return, the profitability, liquidity, activity, leverage, and market ratio. And we have the benchmark from the fundamental analysis, which the natural level is CR or current ratio more than 1, and quality of the number is CR equal to QR, historical trend, getting better or worse, industry benchmark above or below average. Then for the investor, the important thing is the ROE, or ratio on equity. We can break down the ROE using DuPont analysis to be net profit margin, return on asset, and financial leverage, and analyze further to identify areas of improvement for the company. Technical analysis. There are so many methods for technical analysis, but in here, I just only give you the 5 examples for technical analysis. First is double top, double bottom. Second is moving average. Third is exhaustion gap. Fourth is support resistance. And last, trend, uptrend or downtrend. Portfolio theory. These are 3 to see. First, optimize risk, return, or efficient frontier. Second is CAPM, or capital asset pricing model. And last is beta value. I'll explain more on capital asset pricing model. Capital asset pricing model is to get optimal or fair required return. We use capital asset model that if you combine 2 portfolios on asset, we want to get the highest return with the lowest risk, but not possible because the most optimized risk profile or combination of risk and return will lie within area near the efficient frontier. Variance of 2 stocks in the sum of the variance of each stock plus their correlation. So, according to capital asset pricing model, the required return, the fair return, is based on the logic is if you have high risk, then you entitled to get high return. High risk, high return. Low risk, low return. No risk is risk-free rate. So, compensation for sacrificing your consumption is the risk-free rate. The higher risk, the higher required return. It is called risk premium. Risk premium is the return on top of risk-free rate that you entitled to get when you carry some risk. Risk-free rate approximation or RE. Capital structure. Before we talk about capital structure, I will tell you what is capital. Capital is long-term source of fund, which is long-term debt and shareholder equity and other instruments that have long-term maturity. So, basically, capital structure is the composition of long-term source of fund, consists of long-term debt and shareholder equity. Capital structures are cost of debt versus equity, Modigliani and Miller theory, optimal capital structures. Modigliani and Miller theory are included capital structure theory, no transaction costs, no taxes. Capital structure of a company does not affect its value. Criticize, we don't live in a perfect world. The Boston Consulting Group's or BCG product portfolio matrix. Look for some kind of balance within your portfolio. Try not to have any dogs, cash cows, problem children, and stars need to be kept in a kind of equilibrium. Funds generated by cash cows is used to turn problem children into stars, may eventually become cash cows. Some of problem children will become dogs. We'll need larger contributions from the successful product to compensate for the failures. Financial shenanigans is mean actions or missions designed to hide or distort the real financial performance or financial conditions of a company. There are seven shenanigans. First, recording revenue too soon. Second, recording bonus revenue. Third, boosting income with one-time gains. Fourth, shifting current expenses to a later or earlier period. Fifth, failing to disclose all liabilities. Sixth, shifting current income to a later period. And last, shifting future expense into the current period. Fraud preventions, opportunity, pressures, and rationalizations. First, build employee ethics. Second, write SOPs that have to be followed if fraud even is suspected. Third, train employees to increase alertness for fraud and how to prevent fraud. Fourth, protective security by hardware or software. Fifth, create whistleblower mechanism. Whistleblowing is an act of reporting misconduct to managers, executives, or other authorities with the power to take corrective actions. Whistleblowing are the tools to empower employees to identify wrongdoing and to protect the integrity of the organizations. For example, of misconducts are violations of regulations, behavior that threatens the public welfare. 4 types of incentive. First is physical, second is monetary, third is social, and last is moral. For example, like a mother who work at the office, they put their child on child care, and when they become late, they pay an incentive to the guard of the child care. Leverage buyout. The brief but clear explanation of leverage buyout is from the case study of RGR Nabisco. In summary, when KKR submit their bidding and convey the intention to the public shareholders of Nabisco that they want to buy their shares at the price of $100, for example. Now the price is about 50 to 60. Now, if they agree, they will let KKR become the management of the company. In meantime, KKR already bought 1% or 2% of Nabisco shares. Now they want the bid. Their proposal is agreed by the shareholders. So they become the top management of Nabisco and they already own just 1% from the public shareholders, buying from the capital market. And that they were authorized to issue debt as a management, using the debt capacity of the company and backed up by the investment banker. Then the proceeds of the debt, which according to the proposal will be used to buy the public shareholders at the price of 100. And then after our public shareholders already bought up, then the only shareholders remaining is only the KKR share. Now they become the sole owner of RJR Nabisco and will be responsible for the debt of RJR Nabisco. Because now they are the owners, so the public shareholders already gone. Already bought up. They are happy because got a lot of profit from the 50 to 60 to about 100. I hope you learn a lot from this video, and if you enjoy this video, don't forget to like, comment, and subscribe. Thank you.